Imagine it's a Saturday afternoon in 2026 and you're driving through a neighborhood that didn't exist 10 years ago. Fresh sidewalks, identical modern farmhouses, for sale signs that look more permanent than temporary. You slow down, not because you're ready to buy, but because you're trying to understand how every other driveway seems full while you're still calculating what affordable even means. A neighbor waves as you park to check a listing on your phone. The price is double what similar homes sold for less than a decade ago. You refresh the page, half expecting it to be a typo. It isn't, and yet people are still buying. That's when the question creeps in quietly. If this isn't a bubble, what exactly is it? No one is using the dramatic language they used years ago. There's no loud panic, no obvious collapse. In fact, everything feels strangely calm. That's what makes it different. The first housing bubble was chaotic and obvious in hindsight. This one feels rational, justified, explained away with phrases like inventory shortage and strong demand. And those explanations aren't wrong. Supply has been constrained. Construction costs rose. Land is limited in high-demand areas. But bubbles don't always form from lies. Sometimes they form from narratives that are partially true. The psychology of Housing Bubble 2.0 is subtle. It's driven less by reckless lending and more by collective belief, a belief that real estate is the safest hedge against inflation, a belief that prices may dip but will ultimately trend upward, a belief that if you don't buy now, you'll be permanently locked out. That last one is powerful. Fear of exclusion fuels urgency. Urgency justifies stretching. Stretching inflates prices further. The cycle feeds itself without anyone explicitly coordinating it. Zoom out and the structure becomes clearer. Over the past decade, asset inflation outpaced wage growth in many regions. Real estate became not just shelter, but a primary wealth vehicle. Investors, both institutional and individual, entered residential markets aggressively. Low interest rates in previous years encouraged leverage. When rates rose, prices didn't always fall proportionally because supply remained tight, and owners with low, locked-in rates hesitated to sell. The market didn't crash, it froze in certain areas and escalated in others. That imbalance created something unusual, high prices supported by limited movement. This is where the hidden part begins. In classic bubbles, overbuilding creates visible excess. In this version, underbuilding and hoarding restrict supply. Homeowners cling to ultra-low mortgage rates secured years earlier. Selling means stepping into a higher rate environment, so they stay put. Inventory shrinks. Buyers compete over fewer homes. Prices remain elevated not because affordability improved, but because turnover slowed. It doesn't look like a bubble because there aren't empty subdivisions everywhere. It looks like scarcity. But scarcity doesn't automatically equal sustainability. When prices remain high relative to income, affordability compresses. Households allocate larger portions of earnings to housing. First-time buyers delay entry. Renters absorb rising rents as landlords pass through higher costs. The strain doesn't explode overnight. It accumulates, and accumulation is harder to detect than collapse. There's also the emotional component. After living through economic shocks, people crave tangible assets. Stocks feel volatile. Digital wealth feels abstract. A house feels solid. You can touch it, improve it, stand inside it. That tangibility provides psychological comfort, which increases demand even when financial metrics look stretched. In uncertain times, humans gravitate toward what feels real. Real estate benefits from that instinct. But here's the deeper tension. When too much of a nation's financial energy concentrates in housing, flexibility declines, mobility slows, labor markets stiffen because people are tied to specific regions and specific rate structures. Capital that could fund innovation or entrepreneurship remains locked in property equity. Housing transforms from a foundation into an anchor. Anchors are useful in storms, but if you never lift them, they limit exploration. The idea of a bubble doesn't require imminent collapse. It requires misalignment between price and underlying economic capacity. If wages cannot sustainably support prevailing valuations without extreme leverage or dual incomes stretched thin, the system becomes sensitive. Sensitive systems don't need massive shocks to wobble, they only need pressure. A mild recession, a regional employment shift, policy changes affecting taxes or lending. In a highly leveraged environment, small disruptions echo loudly. But here's the paradox. Many homeowners today hold significant equity. Lending standards are stricter than in past crises. There isn't widespread subprime chaos. That's why Housing Bubble 2.0 doesn't feel reckless. It feels engineered through structural imbalances rather than obvious fraud. It's not built on lies about income. It's built on assumptions about perpetual demand and limited supply. And assumptions, even rational ones, can calcify into overconfidence. The powerful realization is this: a bubble isn't just about price spikes, it's about collective psychology reaching a point where alternatives feel irrational, when renting feels like failure, when waiting feels dangerous, when questioning valuations feels naive. That's when belief becomes self-reinforcing, and belief, when concentrated, can distort markets quietly. America's hidden housing bubble 2.0 may never explode in dramatic fashion. It might deflate slowly through stagnation, inflation-adjusted declines, or shifting demographics. Or it might continue climbing in select regions while hollowing out affordability for younger generations. The outcome is uncertain, but the underlying lesson is clear. Housing cannot outpace income forever without consequences. Eventually, math reasserts itself. The perspective shift is this: the real risk isn't whether prices fall tomorrow, it's building your entire financial life on the assumption they never will. If you buy with margin, with resilience, with awareness of cycles, you participate wisely. If you buy purely from fear of missing out, you're betting on sentiment, and sentiment is fragile. In 2026, the housing market doesn't look like a classic bubble. It looks stable, even strong. That's what makes it powerful. But stability built on stretched affordability and collective urgency deserves scrutiny, because bubbles aren't defined by noise, they're defined by imbalance. And sometimes the quietest imbalances are the most dangerous.